Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Rick Rule, as the chairman and founder of Global Resource Investment LP. He's also a director, president, and CEO of Sprott U.S. Holdings, Inc., where he leads a team of highly regarded and internationally recognized earth science and finance professionals, some of whom I was privileged to meet a couple of years ago up in Toronto in the Sprott offices. I've known Rick for quite a few years now, and I've always known Rick to be really a very likable person, always very witty, and had a lot of very interesting speakers. So if you get a chance to hear Rick speak or follow him on the internet, he does a lot of interviews there, I would highly encourage you to partake of the insights that he has, and he shares very lavishly with people. So thanks for joining me again, Rick.
Always a pleasure, Jay. Thanks for having me on.
It's always good to talk to you, always interesting, and there's never enough time, so let's hop right into it. You know, you've been known for quite a while as a person who I can just remember how many times I've been to these investment conferences, and, you know, we're starting to feel pretty good about things. We're starting to see our gold shares go up a lot, double, triple, quadruple, these speculative things, you know, and we start to think we're pretty smart. And then I hear a guy named Rick Rule saying, you know, folks, this party is getting a little out of hand here. We've have record attendance at this conference. We haven't seen it this big since the last time, and then you remind us that the last time there were this many people gathered in one place to celebrate mining shares going up was the end of a lot of fun. Where are we now, Rick, in terms of this move in gold and precious metals? You know, it started, I would say, around February of this year. What inning of a 9-inning ball game are we in now? Is this second, third, or are we seventh or eighth inning?
No, I think we're in the second or third inning, to be sure, Jay. I guess a couple ways that we could deal with that question, but the most interesting way, I think the most relevant way for me to deal with it, is that in my 40 years of experience of watching the gold market, the precious metals market, the most important determinant on the gold price has been the strength or weakness or confidence in the U.S. dollar, and in particular the U.S. dollar expressed by the U.S. 10-year Treasury. Since 1982, the yield on the U.S. 10-year Treasury has fallen from 15% to 1.68, 1.69%.
Yeah.
And I would suggest to you that means that the bull market in the U.S. 10-year Treasury is much closer to the end than to the beginning. Could the rate go lower? Of course. But arithmetically, the move from 15 to 1.67 tells you that the move is closer to the end than the beginning. And if you believe that past is prologue, meaning that gold trades inversely to the U.S. 10-year Treasury, that means to me simply that the bull market in gold is closer to the beginning than to the end. Mm-hmm. The second thing with regards to the gold equities, in particular the junior equities, Jay, is that those equities measured by the TSXV fell by 90% in real terms. That means the market fell by half, and then it fell by half again. And then for good measure, it fell by half a third time. A market that's down by ninefold, that has then enjoyed an 80% gain, basically the up move on a long-term chart almost doesn't register. Now, that isn't to say that you can't have a retrenchment in a bull market rally, and I suspect we will. It wouldn't surprise me at all to see the market that we're in, particularly the junior resource equities, back and fill to consolidate the gain. And for some people whose expectation of the future has been formed as a consequence of getting hammered for the last 5 years, this little retrenchment will cost them a lot of confidence. But it's important, Jay, that your listeners remember the bull market, the recovery that we enjoyed in 2001, 2002. When the market was up by 50% in 2001, everybody thought it was a head fake. A lot of people sold out, and as a consequence of that, missed 100% move in 2002 and the early part of 2003. Mm-hmm. I suspect this market has a long way to go. It just might not go there immediately.
Yeah, I suspect a lot of people are seeing this as a head fake as well. Rick, I've heard the people say, talk in those terms anyway. One thing about silver, I don't know if you have an opinion on this, but Michael Oliver, who was on with us earlier, was saying that he always believes that when we get these bull markets in precious metals, that silver will outperform gold. And it was one commentator, one writer for Sprott, in fact, was suggesting that this is a head fake, perhaps, because we're not seeing silver move ahead of gold. Any thoughts on that?
Yeah, people are impatient. This takes a little while. My own experience has been that gold always leads silver. You will notice that the presage in the gold market was the gold equities markets, which actually began to move up in October before the gold price moved up. And it's instructive to note that the silver equities have moved along with the gold equities, which might presage a move in silver. But my own experience has been that gold has always led the silver market, but that the silver market, when it begins to runs faster than the gold market. Now, that isn't based in any empirical sense. It's just observations of a guy who's been hanging around those markets for 40 years. But I would also, Jay, and I think you and I have talked about this before, there is a subset of silver investors that I sort of joke about as being gold bugs on steroids. And I think they're going to be by and large right. They just need to be a little more patient.
Well, it's the silver markets, of course, being much, much smaller than the gold markets. The gold markets are much, much smaller than the treasury markets that you were talking about. Is there any reason? I mean, if we're not in a bull market for gold and silver, I don't see any reason. There's no reason to own these penny mining stocks, I mean, unless we are. And if we are, as Doug Casey points out, these are speculations. They're not investments. We should keep that in mind, depending, of course, where you're at and what kind of companies you're buying. There's certainly all grades from pure exploration all the way up to producers. But, I mean, we've just been through a really tough one. I had Doug Casey on this show a few weeks back, and he was going through this long list of things that make the mining industry so undesirable. What a horrible industry it is. You've heard Doug talk about it, and you know it as well as Doug does, how difficult it is. Doug noted that you can make huge gains in junior mining stocks, but you just have to realize that you're speculating and you're not investing. I'm sure you agree with that, right?
I absolutely do. At some of the conferences that we attend together, Jay, I make fun of the speculators and talk about investments. And then my wife always says, Rick, you're being disingenuous. All the money that you now invest, you made speculating. And the truth is the same with Doug. When he talks about all the other investments he's made them all as a consequence of the money that he's made speculating in junior resource stocks. It's the sector that we all love to hate. But the truth is, what you have to remember about the junior resource market is that it rewards you extravagantly, and then it punishes you extravagantly. People who are going to play in the game need to understand, first, as you said, Jay, that it's an extremely speculative activity. The second thing is that securities analysis is more important than betting the waterfront. In other words, there's probably 200 companies out of 1,500 in the world that are worth speculating on. And finally, that it's extremely cyclical, meaning that you need to get involved when it scares you the most. And when you're feeling the most comfortable, the most confident, you have to exit. This is a bull and bear market that either way takes no prisoners.
Yeah, I guess the difficult thing is being able to gauge that, Rick, and I think I've sensed that you've been able to do it as effectively as anyone I know, and I know you're always one that you're not afraid to blame yourself and to at least act humble, even if perhaps you're not. You shouldn't be acting humble. I don't know, but I mean, you're always one that is willing to say, "I've made mistakes in the past." Good for you, because I think that's how we learn, by owning up to our mistakes. But as I said, I can remember so many times in the past when you were suggesting to people that it's time to take some money off the table, and I'm sitting up there maybe on with a panel discussion or something, and I'm saying, "No, Rick, no, don't tell me that now." But how do you sense when enough is enough? I'm looking, for example, Rick, I'm looking at my portfolio in my newsletter over since this year. Okay, so I'm looking at my producers up on average 115%. I'm looking at my exploration, the most speculative group of stocks, some of which haven't even have a 43-101 yet, and they're up 208% as of last week. I mean, isn't it time? I mean, you would think maybe we should take some money off the table along the way when you get a double?
I think the answer to that is yes. I have a little stock, which unfortunately I don't own enough of, that I bought for 10 cents. And the stock's at 40 cents today, and nothing has changed, particularly with the company. It's all sentiment. And normally I say sell enough that you have your capital and the capital gains tax paid. The truth is I sold the whole position. It gave me everything I wanted plus. And I want to draw a distinction, Jay, between the investment quality gold stocks that you might own and the speculative gold stocks. With regards to the investment quality gold stocks, it's pretty easy is the wrong phrase. It's possible to do enough fundamental analysis that you can derive a rational target for the net present value of that company in various gold price scenarios and set appropriate trailing stops to protect a substantial portion of the gain which you have already enjoyed. With regards to the speculative part of your portfolio, from my experience, money has been made in speculation by taking a position in a stock that is going to answer some unanswered question in some identified time frame. If the answer comes back yes, and the stock performs as you had anticipated, you should sell the stock. If the answer comes back no, then you should sell the stock. If the answer comes back yes, but the stock hasn't performed, then you should buy more stock. It's important, I think, that you set a plan for what you're going to do with the stock, why you're buying the stock, when you buy it, and at the very least, revisit that plan, at least quarterly.
Well, certainly, I'm looking at a life cycle of the Junior Explorer that appeared in Brent Cook's Exploration Insights letter, and you've seen this this sort of schematic as well, where you have the exploration stocks, and it's when the first drill hole is put down and they hit 10 meters of 2 ounces of gold or something. Wow, the stock just run. Then you hit another one, a step out hole, and 2 or 3 more of them along strike, along trend. And they come back and, wow, everything just goes absolutely nuts. Meantime, you don't know if it's economic or not, but the market is absolutely just going bananas over it, right? And I guess the question is, I guess investors need to be aware of when the drill results are coming in, how many more of them are coming in, and then I think what you just said is very important. And going back to revisit, what is your plan? What do you expect out of this stock? Because I think, I'm talking personally now, I don't do enough of that. I buy something, it looks good. I think, okay, we made some money, but it's going to get bigger next season, another drill season, and it's got all this exploration potential. But I guess you got to just you got to be willing to leave somebody else have some of the higher risk profits that might be out there yet, right? You got to be willing to sell and let somebody else stay in the stock until it reaches that peak in the exploration cycle.
I think that's absolutely true, Jay. And you also have to either do enough work so that you can quantify in some way, shape, or form the result of the press release, or else pay somebody, a newsletter writer, a broker, or somebody, or both, to do it for you. A press release of a drill hole has to be taken in context. What we do here at Sprott is, before the drill hole, we look at the data that went into the drill hole. And we put in place a target size for the deposit. In other words, we try and quantify what various outcomes will be worth before the outcomes come back to us. In terms of the strike length and the width of the deposit, where the third dimension becomes the depth and the fourth dimension becomes the grade, we try and say if A, B, and C happen, this validates a 1 million ounce deposit or a 2 million ounce deposit. Just looking at the press release without having any context to put the data doesn't do you any good. all you're then trying to do is anticipate the impact of the news on the market. In other words, you're counting on other people being even dumber than you are, which is a tough way to make money. You need to be willing to put in the work, or at least buy somebody who is willing to put in the work to put that information in context.
All right. Well, I mean, you guys do your early homework, as you say, trying to understand what the potential of the deposit might be before the first drill hole goes down. You start to get an idea of what that might mean, and in your own minds have a sense of where, what you expect to happen. And you went through the scenarios if it happens, if it doesn't happen, and so on and so forth. But before you get to that, I think the most important thing, and you've made this point many times in the past, it's so obvious actually, but it's not so easy to do, and that's to pick good management teams, to know whether you have a good management team. And there was an interview you did recently, I read something about, you were talking about that. Tell our listeners what it is that you look for, especially specifically in this mining sector, for good management.
Jay, the most important thing by now is to find somebody who has already been successful at least once in a role that's very, very, very successful to the role that he or she is playing in the current endeavor. Many people will say to us, I have been successful in mining. And it turns out that success may have been operating a gold mine in Archean terrain in French-speaking rural Quebec, where the job they have assigned themselves now is exploring for copper gold in young tertiary volcanics in Spanish-speaking Peru. Those are not equivalent tasks. You want somebody whose success comes in a skill set that's very closely resembling the skill set at hand. The second thing I've learned is that you don't make real money having employee managers. You make real money having owner managers. Doug Casey taught me 30 years ago that if somebody isn't going to get really rich, they're not going to work hard enough to make you rich. You want people whose reward is not going to come from salary, but rather is going to come from share ownerships. And by the way, not free options, stock that they bought and paid for. So you want to do business with partners who have been successful in the past in activities that are very closely related to the activities that they're engaging in on your behalf.
And you want to see them have skin in the game. You want to see their interest to be aligned with your own. And I know that certainly for investors that want to do their own homework, they can find out what the salaries are of the management teams that of the companies that they're owning. And I think that's something that probably I should do more of too. It's very easy for companies, managements of companies, if their goal is not to really make money by building up something, but rather to just keep the game going a little longer and raise some more money and pay themselves a good salary and live the high life. And certainly we see this a lot less of it now, Rick, than we saw at the top, say 2010, 2011. A lot of that tomfoolery have been kicked out of the market, I think. What areas in the world are you looking at and Sprott looking at? What areas would you perhaps avoid right now, and what areas are you more keen to get involved in terms of the geopolitics and mineral potential?
Well, we've always prospered by taking risk, Jay. So I would say that I am much more tolerant of political risk than I am technical risk.
Yeah.
So, I have found myself, I've made lots of money in very ugly places like Congo and Eritrea. I'm maybe more comfortable with political risk than many of your readers or listeners. What I've learned personally over 40 years in speculative markets is that the most dangerous government is the closest one to me. So the most money that I've actually lost in terms of political risk was here in the People's Republic of California, Castle Mountain. Now, the truth is that your listeners need to do a psychological audit on themselves and determine whether they have the psychological, not the financial, but the psychological staying power to be involved in countries that they hear very bad things about on the nightly news. The essence of wealth is enhancing one's sense of well-being. And if you're driving yourself crazy while trying to make money in speculation, maybe what you're doing is self-defeating. But I have found, Jay, that for people who look like you and I, we make the mistake of equating political risk to social and political risks we understand less well. The truth is that wealth that's stolen from us by white people in English, according to the rule of law, is just as gone as money that's stolen more efficiently in Africa by traditional methods.
That is absolutely true. And somehow we think our governments, some people think our governments are doing us a favor by stealing our money.
Right.
Well, that's so. Okay, so South Africa and places like that, I guess if the project is right and the management is right, you might consider it.
Yeah, we're participating in two very nice projects in South Africa right now. We like them because we think they'll be lowest cost quartile producers in platinum and palladium. The market hates platinum and palladium, and the market hates South Africa too. And the consequence of that is that we're able to participate in some risky development schemes down there at prices that are probably literally 5% of the prices that we would have been experiencing in 2010. That's an awful lot of fun, Jay.
Yeah. Okay. And I guess through some of the funds that Sprott has, let's just take a minute to talk about what some of the products that Sprott has that people might want to take a look at. You have mutual funds and you have ETFs, right?
We do. For most American investors, there are really three ways to interact with Sprott. One would be our New York Stock Exchange traded precious metals trusts, the Sprott Gold, Silver, and Platinum and Palladium trusts. We believe that these are the most efficient mechanisms in the market for American taxpayers to participate in the ownership of physical precious metals. They're New York Stock Exchange traded, so the transaction costs are very cheap, particularly when compared with owning bullion directly. But secondly, because they're trusts, capital gains, if you enjoy them, are taxed at the capital gains rate rather than at the ordinary income rate that you would pay if you owned bullion. The second way to interact with Sprott is in our exchange-traded funds. We have the Sprott Gold Miners ETF and the Sprott Junior Gold Miners ETF, which are factors-based ETFs. These are good for investors who don't want to spend the time necessary to study individual stocks, but want to be involved in either investment-grade gold stocks in the Sprott Gold Miners ETF or speculative stocks in the Sprott Junior Gold Miners ETF. For more bespoke financial services relating to natural resources, opening a brokerage account or a management account with Sprott Global Resource Investors, which is our retail and institutional investment bank and brokerage arm, is probably preferable, where we can craft an investment portfolio more specifically customized to the needs of the investor.
Okay. Sprott is known for its resource investing. Do you do anything besides resources? I think I saw something about an ETF that covers social media or something like that.
We have a very small ETF that's non-resource operated around social media and big data, going back really to our founder, Eric Sprott's expertise in terms of markets and also technology. And for your Canadian listeners, we have a whole range of investment products, about 50% of which revolve around private credit and private lending. I think we're the largest of the Canadian asset managers in terms of prior credit and high yield strategies for Canadians. But those products are only available to Canadian investors.
Rick, we've spent most of our time here. I've got a couple of minutes left. We spend most of our time talking about gold and silver and mining shares. You are known as well for your energy expertise. What's your reading on the oil and gas markets right now?
Well, the cure for low prices has always been low prices, and the cure for high prices has been high prices. We had very high oil prices, which of course led to increased supply and reduced demand, which cratered the oil price. When the oil price got cratered, some marginal production got shut in, and things like U.S. gasoline sales increased. So we're beginning to see an increase in the oil price. This increase has been too little too late to save the oil and gas industry from what I see as a real credit contraction in the third quarter of this year. So what energy investors are going to want to look at is opportunities in distressed debt. I think the oil and gas junk bond market is going to be an absolute train wreck for the next 12 months. It's going to be horrific for people who don't know what they own and head into it long. It's going to be absolutely fantastic for people who pick among the flotsam and jetsam in that broken market in the first and second quarters of that year. Sprott will likely be allocating about $1 billion to the business, a very, very, very large sector bet.
Any I guess, ETFs or any mutual funds that Americans might look at, or
no? This will be a bespoke product. We'll do it probably in individual accounts.
Okay, understood. Very well. So, there's certainly a lot of things going on at Sprott. One last thing yet, uranium. Any hope for the uranium sector?
Oh, always hope for the uranium sector. I see the industrial materials part of the resource business having bottomed, but I see a long, flat bottom like we saw in gold. I think you're going to be 18 months away from a real recovery in industrial materials. The industrial material that I see moving the furthest is probably uranium. The truth is it costs the industry worldwide about $60 a pound to make the stuff.
Yeah,
so they make
selling
it for
half that.
Yeah, I mean, they make it for 60, they sell it for 35, they lose $25 a pound and try and make it up on volume. This is a no-brainer.
Rick, we're going to have to say we have to leave go at that because we are out of time. My engineer is kicking me off the air. So thank you so much for being with us, and we'll definitely have to do it again sometime soon. Where can people go? Just tell us people should go Sprott, go to their website.
Go to www.sprottglobal.com and click on Contact. We will evaluate your natural resource portfolio for you if you send it to us, absolutely no obligation. And also subscribe to Sprott's Thoughts, the best ideas from the whole Sprott world. I guarantee your listeners will get their money's worth because it's absolutely free.
All right. Well, thank you so much, Rick, for that.